Hey there, future homeowner. Welcome. I'm Kris McCullough, retired Marine, loan officer, owner of the KDM Team. We're known for funding loans other lenders fear, and we fund homes, build dreams. Today, I'll show you what closing costs cover, how to lower them, and the rate for credit trade-off. No jargon, just straight talk so you walk into that house confident and smiling. Grab a coffee. This is a friendly conversation, not a lecture. We'll break closing costs into simple buckets, walk saving levers, and run real math. And yes, we'll do numbers. Don't worry, I'll keep it friendly. Many first-time buyers think closing costs are a monster under the bed. I'm here to turn the lights on and show you the map to conquer it. Ready? Let's demystify closing costs and keep more of your hard-earned money. First up, what exactly are closing costs and why do they exist? Closing costs are the fees you pay to finalize your mortgage beyond your down payment. They're the get-the-keys costs that cover the team who makes the transaction safe. Think lenders, appraisers, title agents, attorneys, and county recorders. Everyone gets paid. Closing costs are just fees for services protecting your investment. Down payment goes to the purchase price. Closing costs pay for processing and protection. Budget both. They're separate and both matter. Appraisals confirm value so lenders don't overlend. Title searches make sure no one else claims the property. Underwriting ensures your file meets the rules. That's why the lender charges a fee. In short, you're paying for peace of mind and a secure transaction. Rule of thumb: expect closing costs to be roughly 2 to 5% of purchase price. On a $400,000 home, that's about $8K to $20K. Wide range, but helpful to plan for. Exactly how much depends on your state, lender, and the loan program. So knowing what's coming and having a strategy matters a lot. Next, let's organize these costs into 3 simple buckets so they stop feeling random. Bucket 1, lender origination. Bucket 2, third party. Bucket 3, prepaids and reserves. Quick, nearly every closing cost fits into 3 buckets. Bucket 1, lender and origination fees. Bucket 2, third party and settlement charges. Bucket 3, prepaids and reserves. It's actually your money, set aside. Once you know the buckets, your loan estimate will make a lot more sense. Think of it like sorting laundry. Separate the whites, the darks, and the delicates. We'll dive into each bucket, starting with lender fees. Let's go. Lender fees pay your lender for the work, risk, and admin of making the loan. The big one, the origination fee, often 0.5% to 1% of the loan. On a $400,000 loan, 1% is $4,000. That's a typical origination example. Some lenders hide fees by bundling costs into a slightly higher rate. You'll also see underwriting and processing fees, usually flat amounts. Those can range from a few hundred to over $1,000 depending on lender. Discount points are optional. You prepay interest now to lower your rate. 1 point typically equals 1% of the loan and might lower rate till to 0.25%. This is the bucket where you have the most power. Shop lenders and get at least 3 loan estimates. Ask lenders to match fees. Sometimes they will. Pay special attention to Section A, lender fees. That's where discretion lives. A better fee structure can save you thousands across the life of the loan. Next, the biggest and most varied category, third-party and settlement charges. Let's break that down. Third-party fees pay the independent pros who protect you and the lender. The lender arranges these, but the money goes to outside companies. Appraisal, usually $400 to $800, ensures fair market value. It protects you from overpaying and protects lender collateral. Title services and title insurance can be one of the pricier items, often over $1,000. Title searches dig up hidden liens or claims on the property. Get an owner's title policy. It's a one-time fee that protects you for as long as you own the home. Worth it for peace of mind. Some states require attorneys at closing. Expect attorney fees where applicable. Recording fees pay the county to file your deed and mortgage. Smaller items include credit report fees, flood certifications, and courier charges. You can sometimes shop title settlement providers. A few calls could save hundreds. Your lender must give an approved provider list and disclose you can choose from those options. Every dollar saved here helps your cash to close. Call around and compare. Prepaids aren't really fees. They're money you pay up front for future bills. This money goes into an escrow account your lender manages for taxes and insurance. You'll usually prepay the first year of homeowner's insurance at closing. You also prepay interest from closing to the end of the month. That's prepaid interest. Close August 26th? You prepay interest for August 27th, 31. That's why your first payment is later. Your first regular payment often isn't due until the first of the following month. Lenders usually collect 2 to 3 months of taxes and insurance as a cushion. That buffer keeps bills paid even if taxes or premiums spike unexpectedly. It's risk management. Your house is collateral, so they make sure it's insured and taxes paid. Lenders disperse those bills on your behalf so you don't miss deadlines. It's basically a forced savings plan for the big bills you can't ignore. Next, 4 practical levers to lower closing costs. You have 4 practical levers to reduce what you pay at closing. Let's turn you into a closing cost ninja. Lever 1, lender credits. Lender covers closing costs for a slightly higher rate. Good if you're cash tight, but okay with modestly higher payments. Lever 2, seller concessions. Ask the seller to pay part of your closing costs. Example, pay $400K but ask for 2%. That's $8,000 toward closing costs. Lever 3, builder incentives. New builds often offer lender credits or incentives. Sometimes agents will contribute part of their commission. Ask politely. Lever 4, shop third-party services. Title, survey, and settlement can be compared. A few calls can save several $100s. It adds up. Pro tip, ask for a side-by-side, total monthly and cash to close at 2 rates. If you're rate sensitive and cash tight, consider a small credit rather than maxing it. Now the big idea, lower fees often mean a higher rate when you take lender credits. Let's use a 30-year, $400,000 loan example with clear numbers. Option A, rate 6.50%, roughly $2,528 per month principal and interest. With Option A, you pay $10,000 in closing costs at closing. Option B, rate 6.75%, about $2,594 per month, but the lender gives a $10,000 credit so your cash to close is reduced. Difference here is about $66, $133 per month depending on the rate choices. Divide upfront savings by extra monthly costs to find break-even months. If your break-even is around 75 months, approximately 3 years. Plan accordingly. Moving or refinancing before break-even. Take the credit. Staying long-term, pay points may win. No universal right answer. It's about your timeline and goals. Want a free side-by-side? Grab my checklist and a 10-minute consult at KrisMcCullough.com. Faku, can I finance closing costs? Generally no. Use credits, concessions, or negotiate price versus credit. Prepaids are timing items. Money you pay now so escrow can pay taxes and insurance later. Yes, program caps vary by loan type and occupancy. Ask your loan officer for rule specifics. Pro tips, get at least 3 loan estimates, compare Section A, and time your closing late in the month. I'm Kris McCullough, owner of the KDM Team. We work in multiple states and fight for your file. Grab the free checklist and schedule a 10-minute consult at KrisMcCullough.com. Links in the description.